Hi traders, Joseph here from EightCap. So today's video we're going to talk about moving averages. They're one of the more popular trading tools used in technical analysis by traders. We're just going to go over some of the types of moving averages that are available and how traders use them in certain circumstances, some of the more popular MAs used in the industry, and problems with moving averages. So we're just going to start with some of the main types. So we have a simple moving average, exponential, and a weighted. So there are a lot of different types of moving averages now. Those three are considered the more traditional, and one of the new ones that are about and around now is the adaptive moving average. So when you're looking at a moving average, we're going to use a 10-day period in this example. A 10-day moving average would be the average out of the closing prices for the first 10 days as the first data point. So the next data point would drop the earliest price, add the price on the 11th day, and then take the average, and that's how it is calculated. So we're going to just have a look at this chart in front of us now, and we're just going to have a look at some of the strengths of a moving average, and then we're going to just talk about how you can use them to see trend and see price momentum. So we have two moving averages on this dollar CAD chart. The first is a 10 and the second is a 20-day period. So as you can see here, when the moving averages are pointing up quite sharply, it's sort of showing you that there's good momentum and that there is trend. So the further that you see retracements and then markets make new higher highs, you're seeing that there's a trend in the market. So this here is a double moving average, and some traders would use the crossover to see the beginning of a price trend. That does work well in situations like this example where there's a lot of strong moves going on, but in a ranging market you will have issues with that, but we'll get to that in a moment. So what other traders will do as well is once price they see a cross and the market moves up, they will then look to buy or sell a retracement. So we can see in this instance price retraced and then we made a new higher high, and that would signal a resumption of the trend. So in that case the moving average is being used basically to look for retracements for future price rises in a trend. And we can see another example here. Once we had the cross, the market moved down, made a retracement, and then the market made a new leg lower. And we can see again here we had a cross, a retracement, and then we had a move higher. And then we had another cross here, but we didn't really have any type of retracement. And the retracement we did get could have set us up for a trade that failed. So we can see once again here after price found support, we made a new cross, price moved up with a retracement, and then price made a new leg higher once again. So that's one way of using moving averages to try and pick trend and retracements. There's another way that traders do use moving averages. It's called multiple moving averages. We'll just sort of show you an example of this. There's been a couple good trading systems out there based on these principles, and you can see where moving averages, the multiple moving averages really condense into one point and then expand. It's sort of showing that the market's ranged and then the market's starting to find momentum again and rally. And we can see here it's condensed up again and then it's fallen, and we can see that the market's making new momentum. And we can see here at this point we've had our change in trend. We've had it's condensed and expanded, and we can sort of see that the Euro JPY is trying to start a new trend continuation, but we'll just have to see how sellers go with that. Now there are some key moving averages that are sort of industry known. The first one a lot of traders use is a 21, which is a Fibonacci number, a 50 period, and then the 200-day moving average. And it's said that a lot of institutional traders do look at the 200 period, and that when we have a price traveling above the 200, it's said to be seen in a bull trend, and if price is trading below the 200-day moving average, it's seen to be in a bear trend. So we can see an example when it came under and then declined down. So we're going to get onto now some of the issues with moving averages, and a good example of that is right here. When they're moving with a good angle of momentum, they can be very useful. The issues traders face is once they go sideways and start to throw up a lot of false signals. So we can see in this period here, if you'd sold, you'd have been stopped out. If you'd bought, you would have been stopped out, and again and again. So that's one of the issues you do have with moving averages, that once the market becomes range bound, you could start to, normally you're going to start to run into trouble if you're just trying to take quite basic signals. So we can even see on the USD CAD here at this position. So even though this buy still may rally higher, that trade still, if you bought that trade at this point, you're still in a pretty average position right now. And again, we can see it here. If you bought this point here, if you didn't have a pretty tight stop loss or break even point, you would have been stopped out. And again, once here, if you bought on this rally retracement point, that trade didn't work out at all. It actually turned into a new decline lower. And another point just to have a look at is, after we had this move lower, if you tried to sell any of these highs at this point, you would have been turned around by this new rally. And we had another example of that here, where after we sold this point down, we had a retracement, what looked like a good continuation developing with rejection from that moving average. That was stopped pretty quickly at that support, and then it actually turned into a new rally. So moving averages do have their limitations. You do have to be a little bit careful with them at the ends of trend or for extended periods. And the other problem is then, if you only try and trade the first, you will get situations where you have a long trending market, like say in this one position here, and then if you only take the first, you're going to miss out on subsequent trades as they go down the line. So these are some of the pitfalls of moving averages, but overall, if you're using them to spot momentum and trend strength, they can be very handy, and they can offer you a bit of assistance, but you still need to add some price analysis into it as well, just to be not blindly following them from a straight buy and sell point of view, because in trends they'll work great, but as we've seen in ranging markets like this, they can set you up to fail. So I hope that video was helpful. If you have any questions or if you'd like to know anything further, please feel free to contact us at support, and until next time, I hope you have a great trading week, and all the best. Bye for now.